You built your LLC, congratulations. That's a huge step, and it took vision, courage, and a lot of hard work. You've put in the hours, made the tough calls, and now you're officially a business owner. But as you celebrate this milestone, there's an even bigger question waiting for you. Are you paying yourself the smartest way possible? It's a question that trips up even the most seasoned entrepreneurs. You might be wondering if you're doing it right, or if there's a better way to make your money work for you. Most business owners don't realize how you pay yourself can make or break your financial future. It's not just about taking a paycheck, it's about setting yourself up for long-term success and stability. Moving money from your business to your personal account might seem simple, but there's a lot more to it. The method you choose can affect everything from your taxes to your ability to invest in your business's growth. Paying yourself is a strategic move that impacts your taxes, your wealth, and your peace of mind. It's about more than just numbers, it's about your future, your family, and your dreams. Too many entrepreneurs treat business finances like a guessing game, taking money out whenever with no plan. This approach can lead to chaos, missed opportunities, and unnecessary stress. That's how you end up with confusion, stress, and a surprise tax bill at the end of the year. No one wants to scramble to find cash for taxes or wonder where all the profits went. You need to understand how to pay yourself, because it's the difference between just getting by and truly thriving. When you have a plan, you can grow your wealth, invest in your business, and enjoy the rewards of your hard work. Your LLC is a powerful vehicle for building wealth, but you need to know how to drive it. Think of it as a tool that, when used wisely, can open doors to financial freedom and security. The way you structure your pay determines your self-employment taxes, income taxes, and even your eligibility for certain benefits. It can also impact your ability to qualify for loans or attract investors. Get it right, and you keep more for your retirement, your family, your dreams. You'll have the confidence to plan for the future, knowing your finances are working for you, not against you. Get it wrong and you're working harder just to stay afloat. You might feel like you're always behind, no matter how much your business grows. Today, we're going to break down your options. No jargon, just clear, actionable advice. We'll cover the pros and cons of each method so you can make the best choice for your unique situation. I want you to feel in control of your money and your life. When you understand your options, you can make decisions with confidence and clarity. This isn't just about saving on taxes this year. It's about building a secure financial foundation for years to come. The right strategy can help you weather tough times and seize new opportunities. Are you ready? Let's get started. Your smartest money move is just ahead. Let's start with the basics. If you're running an LLC, understanding how you actually get paid is one of the most important things to know. It's not always as straightforward as getting a paycheck from a regular job, and the rules can be a little different depending on how your LLC is set up. The IRS doesn't have a special tax category for LLCs. Instead, it treats LLCs based on how many people own them and how you choose to be taxed. This flexibility is one of the reasons LLCs are so popular with small business owners. If you're the sole owner, your LLC is a disregarded entity. That means, for tax purposes, your business income is reported directly on your personal tax return, just like a sole proprietor would do. There's no separate business tax return required for the LLC itself in this case. If your LLC has multiple members, it's taxed as a partnership by default. Each member reports their share of the profits and losses on their own personal tax return. The LLC itself files an informational return, but the actual tax is paid by the members, not the business. Here's the key. No matter how many members your LLC has, all your net profit for the year is considered your personal income, even if you don't actually transfer the money out of the business. This means you could owe taxes on money that's still sitting in your business bank account. You must set aside money for taxes on all profits, not just what you pay yourself. It's easy to forget this and end up with a surprise tax bill, so planning ahead is essential for every LLC owner. For default LLCs, you don't pay yourself a salary like a regular employee. Instead, you take what's called an owner's draw. This is simply a transfer of funds from your business account to your personal account whenever you need it. Remember, a draw isn't a business expense and doesn't reduce your taxable profit. It's just a way to access the money you've already earned through your business activities. So when you take a draw, you're not avoiding taxes. You're simply moving profits you've already been taxed on, or will be taxed on, into your personal account for your own use. Understanding this process is crucial to avoid tax surprises and to make sure you're setting aside enough money throughout the year to cover your tax obligations. Now let's look at your options for getting paid from your LLC and how you can choose the best method for your business goals. The default way to pay yourself from an LLC is the owner's draw. Simple, but not always best. The catch? Self-employment tax. You pay 15.3% on all net profits, not just what you take out. When you work for someone else, your employer pays half. As a business owner, you pay it all. That's a big bite out of your earnings. But there's an alternative: electing S Corporation status for your LLC. With S Corp status, you can pay yourself a W-2 salary, just like an employee. Only your salary is subject to payroll taxes. The rest of your profit can be taken as a distribution, which isn't. This is the key distinction that can save you thousands. We'll break down how it works next. Ready to see the numbers? The S Corporation election is your secret weapon. You're still an LLC, but you're taxed as an S Corp. This lets you split your income, part as salary, part as distribution. Pay yourself a reasonable W-2 salary, subject to payroll taxes. The rest? Take it as a distribution, which avoids the 15.3% self-employment tax. Example, if your LLC makes $120,000, as a default LLC you pay self-employment tax on all of it. As an S Corp, pay yourself a $60,000 salary, taxed, and take the other $60,000 as a distribution, not subject to payroll tax. That's over $9,000 in tax savings. This is a legitimate IRS-approved strategy. Yes, it's more complex, you'll need payroll and a new tax form, but the savings are real. Run the numbers for your business. For many, the S Corp move is a game changer. Don't get greedy. Your S Corp strategy only works if you pay yourself a reasonable salary. The IRS requires it. If you lowball your salary, they can reclassify your distributions and hit you with penalties. So what's reasonable? It's what you'd pay someone else to do your job. Consider your duties, experience, hours, and what similar roles pay in your area. Use sites like Glassdoor or the Bureau of Labor Statistics for research. Document your reasoning. If you're ever audited, you'll need proof. Some use a 60-40th split as a rule of thumb, but it's not official. The best approach? Be factual and fair. Think, what would it cost to replace you? Be realistic. The goal is legal tax savings, not raising red flags. Get this right and you'll maximize your benefits. Now let's talk deductions. Deductions are your best friend. Every legitimate business expense reduces your taxable profit and your tax bill. Don't be afraid to claim what you're entitled to. Home office, business mileage, software, equipment, marketing, insurance, professional fees, all deductible. Even the employer's share of your own payroll taxes is deductible for S Corp. The secret? Impeccable record keeping. Use a dedicated business account and accounting software. Track every expense, keep receipts, and stay organized. If you're ever audited, you'll need proof. Don't leave money on the table by being sloppy. Deductions add up. Take every one you legally can. Now let's talk about paying your future self. Tax savings are great, but what are you doing with them? The smartest move: invest in your retirement. As a business owner, you must create your own pension. The good news? You have powerful options. SEP IRA contribute up to 25% of compensation up to IRS limits. Simple IRA, great for businesses with employees. Solo 401k, for self-employed with no employees except a spouse. Contribute as both employee and employer, often more than a SEP at lower incomes. Contributions are tax deductible, lowering your taxable income now and building wealth for later. The earlier you start, the more you benefit from compounding. If you're an S Corp, contributions are based on your W-2 salary. Talk to a financial advisor and start now. Your future self will thank you. Next, let's look at the changing tax landscape. Tax laws change, sometimes fast. In 2025, many provisions from the 2017 Tax Cuts and Jobs Act may expire, including the Valuable Qualified Business Income (QBI) deduction. If QBI goes away, S Corp tax savings become even more important. Stay informed, have a great CPA or tax advisor on your team. Don't skimp here. A good accountant saves you more than their fee. Meet with them at least twice a year for proactive planning. Subscribe to reputable financial news and accounting firm newsletters. Being informed is part of your job as a business owner. You don't need to be an expert, but you do need to ask the right questions. Knowledge is money, especially with taxes. You've just taken a huge step by learning the difference between a draw and a salary, and how each impacts your business and personal finances. You now understand the power of the S Corp, the critical role of deductions, and the importance of funding your retirement for long-term security. But remember, knowledge alone isn't enough. It's what you do with it that counts. Action is the bridge between where you are and where you want to be. So here's your first step. Schedule a tax strategy review with your CPA. If you don't have a trusted advisor yet, make it a priority to find one who understands small business needs. Ask them to walk you through a side-by-side comparison of your tax bill as a default LLC versus an S Corp, so you can see the real numbers for yourself. Have them help you set a reasonable IRS-compliant salary, and discuss how to optimize your compensation for both tax savings and personal goals. Next, get your bookkeeping in order. Use reliable accounting software to track income and expenses and keep your records up to date. Open a dedicated business bank account and make it a habit to track every single business expense, no matter how small. This is non-negotiable if you want to maximize your deductions, avoid costly mistakes, and make smart, informed decisions for your business. Finally, give yourself permission to pursue a better financial future. Approve yourself to take bold steps and embrace new opportunities. Remember, you are the CEO of your life and your business. Don't let fear, doubt, or procrastination hold you back from what you deserve. The tax savings and financial clarity you unlock could be the difference between just getting by and truly thriving as a business owner. Take control of your money, your business, and your future, starting right now. You're smart enough, capable enough, and strong enough to make this happen. Trust yourself and take the leap. Now go out there, take action, and make your LLC work for you in ways you never thought possible. Your financial future starts today. Let's do this. Your journey to financial empowerment begins now.